Hey, what's up guys? Q here from Hyperstocks. Today we're going to go over some of the charts that some of the members in my group requested, but you don't have to be in the group for you to pay attention to this because this is vital information. I feel like you can take away a lot from this, only because these chart lessons really apply to a lot of the stocks that you take a look at. So why not get some experience with some actual charts? That way you understand what ranges look like, what zoning looks like, setting up support and resistance lines, reading daily charts, reading daily candles, reading micro candles. So in this video, I'm going to try my best to be as thorough as possible with everything that I say. That way you can take a lot from it and maybe apply it to your own trading down the line. So without further ado, let's go ahead and get started. I've had about maybe 8 chart requests from my group in the Hyper community, and today I'm just going to go through them. Like I said, this is probably going to be outdated information by the time you guys watch this in the future, unless you're watching it today, which is July 21st, 2020. But needless to say, a lot of the lessons I'm going to teach you are going to be timeless. So I hope you take a lot from this. If you like what you see, please go ahead and like the video. If you're not already subscribed, go ahead and subscribe. Let's go ahead and get started. Our first chart request is going to be PK. So I'm going to go ahead and erase what's going on here, what I've already drawn out on PK, and I'm going to explain a little bit of what's going on in the market as of July 21st, 2020. So it's very important that when you're trading stocks, you understand the health of the overall market. If obviously we're going through COVID-19 crisis, then expect the market to not act as healthy as a normal non-pandemic time. Obviously, the economy is straining and a lot of people and investors are uncertain about what's going to happen next. With that being said, when you're trading stocks, you have to be prepared for the worst, even when the chart looks good. So charts like PK, although the setup may look fantastic, you have to keep in mind that it can go south at any moment with just one single bad headline about the vaccine treatment, or perhaps any type of leisure, because this is a hotel's stock. So any type of negative news towards leisure may take the stock down and make your setup fail, which is where your stop losses kick in. And that's why it's so important to know your support lines before you even enter the stock. So always have an exit strategy, whether that's profitable or at a small loss, but make sure your win ratio doesn't outweigh the loss. For example, if you have a price target of $11 for PK, don't put your stop loss at $8.50 when it's trading at $9.37, because now you can lose more than you can gain on the stock. So it wouldn't make sense for you to create your setup like that. You would want a short range stop loss and a longer price target. And you don't just make price targets up. You have to know how to engineer your setups and your trades, and that comes through experience and obviously understanding how to chart properly. So in terms of PK, let's go ahead and take a look at what's going on in the daily candles. So I've got my chart set to daily candles, and I'm taking a look at what the stock is doing as of July 21st, 2020, where the stock had a green day compared to the previous day where it closed at $8.85. Today it closed at $9.37, which was strong enough to close it above the 10-day moving average, but not strong enough to close it over the 20-day moving average. Now, if you don't know the significance of moving averages in stock trading, you need to review these indicators, because they are going to be one of the best telltale signs of what's going to happen in the stock and just how strong it is in terms of its placement on the chart. For example, when the stock is trading under the 10-day moving average, that's typically a bad sign that it's going to keep getting rejected by it until it gains enough volume or gains enough momentum to push over it. But even then, the volume may not be enough, just like how it was on July 10th, to completely push it over, and it just gets pulled back down. That's how significant the 10 and 20-day moving averages, and they are by far the most popular moving averages out there in terms of reading charts, at least on the short term. Some people will prefer 9 and 18, but that's subjective. You can choose whatever you'd like and whatever works for you. But anyways, in terms of PK, it looks like the stock was strong enough to gap up over the 10-day moving average, but it's not really telling us too much, because it looks like the stock is still very low in terms of the trading range that it's sitting at. So if you wanted to trade the stock, let's see how you can trade it for yourself and what will be some different zones that you could use for your own personal entries and exits. So I've already drawn it out on this one. I haven't drawn it out on the rest of the charts because I wanted to go through them with you. But I've drawn out some zones for you. This in red is the most dangerous zone that you could be in for PK because it's on the verge of breaking the 920 support, in which was the breakout point that led it to consolidate on this area. If you notice in this very section right over here, the stock had managed to create a bullish flag and it consolidated between 920 and 930 after breaking the 920 resistance. The 920 resistance is only the resistance because back in July 17th or July 18th, right around that date range, the stock had used that support at 920 but failed to hold it and broke below it. Therefore, for the stock to get back into healthy territory, it needed to push back over 920, and it did successfully and consolidated with this bullish flag until it pushed over 930. So between 920 and 930 was its first consolidation period, in which the stock had moved sideways after making a big breakthrough, and then finally got the energy again to break above 930, making that your second trading range, or the second safest trading range to enter the stock in. So if you choose to trade the stock between 930 and 945, you can go ahead and enter the stock and use 930 or a higher risk stop loss at 920. So 930 would be the safest stop loss, 920 would be the second safest or the high risk stop loss. Now your next trading range is going to be between 945 and 960, and that's where you start getting into the safer zone of trading, because now PK has made a significant move back from dropping below that 920. You could see that the stock is now back in trading range and it's making higher highs and higher lows rather than making lower lows and lower highs, what you don't want the stock to do. So here 945 would be your breakout point. If you wanted to use a breakout strategy on the stock, that would be the way you would approach it. You'd approach only after the stock breaks out of 945, and that's if you are the safest trader. These zones are just meant to label the safer trader from the non-safe trader, and you can use them for your advantage when you're making your trades, knowing where your high risk stop losses are and your strong resistances are for the next breakouts. So a lot of traders, the mistakes that they make is they don't usually lay out their trading zones. They don't lay out their resistance and support lines. Therefore, they don't have an exit plan in case things go south or even when things go for them. So you'll notice that maybe amateur traders or non-experienced traders will not know when to take profit, unfortunately, even when the stock is going into their favor. But there is a stop limit that the stock will reach before it gets rejected. For example, if PK makes it all the way up to 980, now you know that it's approaching a very significant resistance. Therefore, you should consider taking profits, especially with it making that big of a move. It'll likely be overbought at that point and it will need a strong pullback to cool it off. Therefore, you need to have an exit plan on the way up just as much as you do on the way down. Now, in terms of my personal sentiment on this stock, I wouldn't really trade the stock at this very range. I would wait for a more solidified move over the 10 and the 20-day moving averages as I showed you on the daily candles. Because as long as the stock is trading so close to the 10-day moving average, yes, it closed above it successfully, but it's way too close for my liking for me to enter the stock here. I would like to see another strong green day take this candle over the 20-day moving average, and then eventually I want to see these cross over to the top side. Do you see how when they crossed to the lower side, the stock fell immediately? Once they cross back up, that's another reinforcing factor that the stock is going to start moving back up to the bullish side. But that's in terms of, so that sums up PK. I hope that stock was a little bit helpful. The next stock we're going to go over is going to be RCL. So RCL and PK are both in the leisure sector, so you have to understand that sectors move together. Therefore, they're likely going to have very similar charts, if not the same exact pattern going on, especially with the way they're all recovering from the COVID-19 pandemic crash. A lot of them are going to be in this weird pennant pattern. At least that's what they are as of July 21st, 2020. And it looks like RCL in this case has created a doji candle. So once again, I'm on my daily candles. the stock created a doji candle, which means that there is an indecisiveness in the price. So the stock had gone up to 54 at one point in the day, and it gone back down to 52 in the day, but it managed to close right below its opening price. So the price from the open to the close was only a 10-cent difference. Although the stock had a $4 swing through the day, I'm sorry, a $2 swing through the day, there was only a 10-cent difference in between the opening and the closing price, which leads us to believe that there is an indecisiveness about the next move of the stock. But there are candle patterns that we can take a look at, and as you become more and more familiar with the market, you'll start to realize and take note of these candles. In this case, RCL is creating a pregnant harami, but a bearish one to the lower side. So this is not really good news for a trader, because when you typically see a inside candle like this, especially if the second one is red, now you're looking at a possible bearish move from the stock, which is actually kind of expected considering the coronavirus is not slowing down. But when we see these things, it doesn't necessarily mean that it's going to follow through perfectly. You have to keep in mind that nothing is definitive on the market, especially in the world of the news that we have. The news acts as a catalyst. Any positive headline can send these stocks shooting up. RCL, or Royal Caribbean, is in the cruise line industry. If a news article comes out tomorrow saying that all cruises are set to come back next month, you better hope, or you better know, that RCL will shoot up. But don't trade the news. Always look back at your charts, take key announcements here and there, take key patterns here and there, and sum them all together and make a smart decision about your trade. Don't just rush into it, or don't rush out of your trade based on just one single thing that you hear or see. So we've summed down that now on the daily candles, there could be a bearish move from the stock. So if you are in this stock or looking to get into this stock, you may want to lay out your supports just like how we did on PK. And in this case, it looks like your support on RCL is going to be right at $52. Now, I say $52 only because I'm noticing the stock keeps on bouncing off that support anytime that it comes down. You can see that the stock bounced off of it here. It bounced off of it here. Here, it dipped just below it. Therefore, it has another small support at 51.50. And then here, it opened below it. So you have two supports that you can work off right away. The $52 support, which is going to be your safest support. And then you have another support at 51.50, which is going to be your more higher risk stop loss if you choose to hold that stock that low. In terms of the breakout points, it looks like the stock had been getting rejected at $54. It got rejected there once, twice. Now, the stock didn't exactly hit it this time, but just because it's that whole number, every whole number for a stock is typically going to be some kind of resistance. So we'll leave a safe resistance at 54 for a possible breakout to our next resistance of going to be 54.75, because that's where the stock had gotten rejected on this candle, where the stock closed at 54. So you can see that on that 30-minute candle, the stock pushed all the way up to 54.75, but closed just below 54 and kept on consolidating. So here on this stock, you have a support at 52. This is going to be your consolidation area right over between these two price points. The stock is going to be consolidating here. Now here, it could either break over 53.75 and push forward to the next resistance, or it can break below and fall way further than 51.50, which is where your stop loss will kick in and save your position. So like I said, very important that you lay these things out on your charts, because without them, you're trading blindly. Even if you can read support and resistance lines right off the bat, it still really helps to have them laid out before you enter the trade, because a lot of traders start to do their research after the fact, when it's too late to finally save your position and understand that the stock may be closing or trading too close to the support or too close to the resistance, or maybe overbought or oversold, and you need to figure these things out before you enter the stock. In the case of RCL, personally, I wouldn't enter the stock until it gaps up over the 53.75 resistance and pushes over between 53.75 and 55 for me to be in a safer trading range where I can foresee the stock breaking out and moving up while keeping an eye on the daily candles, because the stock did indeed make this red candle that worries me a little bit. So what I would like to see in the next few days is a strong green candle that confirms that this crossover is legitimately going to start taking the stock up and it's not just a fake breakout or a bull trap. Now the next chart I got is TXMD that we're going to go over, and notice that there's a lot of good lessons here because these charts are really varying between these prices. This, for example, this is a $2 chart. The previous one was a $50 chart. So it's really good experience because it really gives you an idea that stocks move the same. No matter what their cost is, they're all going to move the same. But the only difference is you have to know the sector that you're trading, and you also have to know that penny stocks are not as affected by the overall market move as much as large cap stocks. Reason being is because penny stocks likely most of the time penny stocks will move strictly based on patterns, and sometimes if you're in the biotech industry, they are going to move based on maybe FDA approvals, which are completely separate from the overall market, and the large cap stocks that move based on perhaps COVID news or bad economy news. Penny stocks are pretty much, they throw all that out the window and they just move on with their day because they're usually focused on by different people, non-investors, which is why penny stocks usually die out so quickly. It's because it's not investors that are trading them. It's just traders like you and me that are just trading them for the short while, maximizing a breakout, and then dumping them completely until they come back around. But in terms of TXMD, you could see that I actually had some support and resistance lines already based or laid out on the chart previously, but the stock had broken out of them completely, so we're just going to erase them. I'm focused on the daily candles right now. It looks like TXMD had a massive day today. It jumped all the way from the opening price of 190 to close at 224. Now that is a pretty big move on a penny stock, at one point hitting a high of 243, which is very impressive. But one thing to note right away is when a stock makes a strong move like this, is it overbought? Is it already moving into overbought territory? And the way you can tell is by looking at the RSI. The RSI is reading over 80 points, which is definitely a sign that the stock is becoming overbought. So you want to take note of that if you are in the stock or looking to get into the stock, that the stock is either going to, one, consolidate or reverse completely. But in terms of TXMD, one thing I want to point out right away is the stock created a cup and handle pattern that led to this breakout, which is absolutely phenomenal because this is a great example of how well these patterns work if you know them. So the stock created this cup, and then it created a little handle, and then it pushed itself up above the resistance of $1.60. Now, why did this cup and handle get created? The answer is going to go back to the psychology of the market. You got to remember that the reason why stocks move is because patterns are seen by traders, and historical patterns and patterns that usually lead to breakouts are only going to follow through the more obvious they are. But why do these patterns happen? And it's because, for example, with TXMD, somebody had bought the stock up to $1.60 at one point back at this time, and then once again they tried to break it over 160 at this point but failed, and then they tried to break it at 160 again at this point but failed, and then what happened next is the stock found support at a critical point that didn't drop it below the 140 support. So as the stock made resistance points at 160, the stock also made supports at 140, and there is a pullback target and then there's a reversal target. You don't want the stock to pull back further than the breakout point. In this case, the stock had struggled at 140 previously, broke out of it successfully, struggled again at the resistance of 160, pulled back, but notice on the pullback the stock stayed at 140. What happened during this pullback, you ask, is it's simple. People took profits. So the people that bought it up from $1.40 took it to 160 and started taking profits in fear that the stock is going to get rejected. And them taking profits is what rejected the stock. It's literally caused by the same person who thinks the stock will get rejected at 160. But on the pullback, notice how it never came down below 140. And that's because not everybody that bought it at 140 ended up selling. They believed in the stock this time and pushed it back up to test 160. And now the people that exited saw that 160 was broken. Their alert went off and they jumped on it right away. You notice an influx of volume and they pushed it up as high as they could before it got rejected at another resistance, which is going to be at $2.44. So that rejection point becomes your new resistance, but there are a few other resistances in your way that you can trade off of, and we may need to zoom in closer to find out where those resistances are and supports are. So I'm seeing a support at $2.25. The way I found that support is simply by looking back into history and seeing where the stock had bounced up before and where the stock had bounced up when it came down. It looks like the stock on this green candle came down and bounced off 220. Therefore, that's going to be your support. So if you are in the stock and you want to trade it tomorrow, you may want to put your stop loss at 220 or maybe even $2 because that's where the stock had gotten rejected before. So you could see that stocks have lots of support lines and lots of resistance lines. You just have to be able to spot them and know your own risk tolerance. So if you're in the stock early on, maybe your risk tolerance is going to be down to the $2 support because your entry was at 160. But if your entry is at $2.36, you may want to reconsider putting a stop loss at 160 and maybe putting it slightly below your entry at the very next support that you have, instead of risking your money all the way down to $2, because there is a point in which the stock will hit a support line, and if it's broken and it's a significant support, the stock will completely sell off. And that's the importance of stop losses and knowing where to put the supports based on the stock's position on the chart. But that's TXMD. Let's go ahead and move on to RNG. So RNG, let's see what the stock is doing, and let's see if we can tell what the stock is doing. So the stock had a pretty rough July 10th and July 13th. Needless to say, the stock dropped a significant amount before, as it hit $300 and got rejected. The stock dropped all the way down to $250, which is a pretty intense drop. So there may be a catalyst that moved the stock on that day. I'm not going to get into researching news, but anytime a stock drops this strongly, you may want to research and see if there's some kind of catalyst that's moving it, because a $50 drop in a couple days, that's not a normal for a stock that's only worth $300. If this was Amazon, I would say, okay, the stock is $3,000. It may just be a pullback. But when it comes to a $300 stock, that's a pretty strong percentage of a drop for the stock to be able to survive. But I have to say the stock has made a pretty strong recovery since. The stock had two back-to-back green days, with this day increasing in volume. So that's something to take note of. The stock's second green day actually increased in volume as it pushed up over both the 10 and the 20-day moving averages. But notice how the stock closed right at the resistance that was made back on July 13th. Therefore, now you need to put a resistance line 1 at 286 and 2 at 288, where the stock had tried to go above but got rejected. So you have two resistance lines already that you can put. One other thing to know about this stock is that it's moving way too vertically. You don't want a stock to move up this way, because moves like that are unsustainable. Just like how the stock came down vertically on the bearish side and bounced back up, when a stock pushes up vertically this way, it needs a strong pullback, and likely going to be to around 275 before it pushes back up and breaks above the 288 resistance. So now that we've found out that our resistance is at 288, which is the highest point that the stock recently made but got rejected, we need to find a few support lines for the pullback target. One is going to be at 275. So when the stock moves vertically, expect a pullback. The stock needs to hold the support on the pullback and consolidate between those two price points before breaking out again. Now you may wonder, why is it that you want the stock to pull back? And the only reason is because as a trader and as an experienced trader, I want a stock to have a healthy breakout. If the stock breaks out of 288 from this very point that it's already at, it's already overbought. How high can it really go? It never really build up that tension. It never really built up that force and volume before its breakout. Therefore, the breakout will be weak and it likely will be cut short. I want the stock to come back and slowly make its breakout this way, so that way it consolidates between these two price points and finally gains enough tension to have that strong breakout that we are anticipating, rather than vertically breaking out and not keeping. And there's a perfect example of that right at this very point, where the stock tried to break out of the 288 price point, but notice how it was cut short. It still did not make it out alive. Even on the pullback and on the way back up, it still couldn't keep that momentum to keep going. And that's because the stock has a historical pattern of having these vertical moves to the top side and to the bottom side that completely make it unsustainable. So that's another thing to note when you're trading. Just because the stock is about to break out, it doesn't mean it's the right trade for you. Look at the stock's history. I mean, look how volatile the stock is. It literally makes $50 to $40 moves almost on a weekly basis, which is not really a stock that you want to be a part of unless you're getting in and out of the stock on very quick scalps. This may not be the best stock to be trading at the very moment, or maybe until it sets a better notion, because right now the stock is way too volatile. It's everywhere. It's not building up for breakouts. It's just moving randomly to the top side and to the bottom side with massive swings, making it a not very ideal stock to trade. The next stock I'm going to go over is called OPK, or Opco Health. So the stock had a pretty big day as well. This one has been in the news or in our community for quite some time now, after the stock recently got an upgrade. Just like TXMD, the stock had a monumental day, but the stock pushed itself right into overbought territory, even pushing 90 points to close the day, which is a very serious thing to take note of. Now, just because a stock is overbought, it doesn't mean it's going to start coming down right away, but it is something to take note of. And you may perhaps be confused, and you may be a little disappointed that you sold the stock so early when it had so much room to run, but you'll thank yourself down the line when you start exiting stocks right when they become overbought, because now you're saving your money. Don't focus on the 100% gain. Focus on the 80% in between, because it's very likely you'll never catch the very top, or you'll rarely ever catch the very bottom for entry. You're going to focus on the 80% in between, and that will make you a very happy trader. But what we're seeing for the stock here is volume keeps on increasing. So there is a ton of potential in this stock, especially in the field that it's in, especially that it's making so much progress in its industry. However, right now is not the time to pick up the stock. If you're already in this stock, you may want to find an exit point and cover some profits before the stock crashes back down on you, because it needs a healthy pullback at this point. It's starting to become way too stretched out. It's like a rubber band. You keep pulling at it, the stronger the snap is going to be when it finally snaps. And so the stock is currently overbought. Let's go ahead and see what it's doing on the shorter term. It looks like the stock had gapped up today. The stock gapped up from $5 to $5.40 right at the opening price. So we already know that sometime in the future, the stock is going to want to fill that gap back down. Considering that this is the breakout point right at $5.08, we can put a support line right at $5.08. So this is going to be the lowest support that we want the stock to come down to before we call it quits completely. So the stock can come down to 508, but it will need to bounce either at 508 or $5, or else if the stock goes below, then it goes below the breakout point, and now it's starting to make lower lows, because everybody who had entered it on the way up from here is starting to hit their stop losses and is starting to take profits and no longer is believing in the stock. Another thing to point out about the stock is it hit a double top right at 620 today, and a double top is going to be considered bearish. It even hit a triple top, if you may say, right at around that 620 price point. So there's a bearish move from you for the stock, and you have a support at $5.80. So if the stock breaks below 580, now it's confirmed that triple top is indeed bearish, and it will keep on moving down, perhaps to its next support of 560 and then its next support of 529. So Certainly not a stock that you want to open a new position in, but it is one to keep on your radar. The stock may pull down to 508. You may want to put a few alerts perhaps on the pullback for when the stock hits at or below the alert. That way, maybe you can find a reversal entry on this one rather than chasing it on the way up. Now, the next stock we're going to go over is called AGS. AGS has a daily pattern that's looking pretty good. This is one of our swings that we're swinging for the chat. So the stock had a nice doji candle. It looks like that was a little indecisive after 3 red days, but notice that 3 red days had very low selling volume compared to the buying volume of the 2 green days that's surrounding them. Stock pushed over the 10 and the 20-day moving average today, which is a very good sign, and it looks like they're on their way to cross up. So there's another good sign for us in terms of the daily candles. Now, in terms of the 1-hour candles, we're looking for the stock for more and more key signs that the stock is on its way of a reversal. First thing I'm noticing, and this is why we entered the stock today, is going to be the positive divergence that I'm seeing from the RSI. So notice how the stock hit $3 twice, which is already a double bottom, but on that double bottom, the RSI had a higher high be created at that $3 mark, which is a sign, or called a positive divergence, that the stock is starting to move back up to the bullish side. So where are our breakout points for the stock? The breakout points are going to be the places it got rejected at. So the stock had a resistance at 365. It has another resistance at 386. So as long as the stock consolidates between these 2 price points, it's in good hands. And finally, its best and final breakout is going to be over $4.20, because that's the point where the stock started to seriously sell off after breaking, and it also bounced off that point a few times. So ultimately, our first price target is going to be 386. If it breaks 386, then our next price target is going to be $4.20. The stock will likely get rejected, so you should probably take some profits at that point and wait for a re-entry if it breaks over 420, and so on and so forth until the stock is done making higher highs, and that usually happens when the stock becomes a little overbought. Last but not least, our final stock to go over is going to be RYAM. So RYAM, in terms of its daily candles, the stock had another strong green day. So you see the stock pushed over the 10 and the 20-day moving averages on the 17th, and then it had a consolidation day. That was yesterday. That's going to be July 20th. So no stock is going to keep on moving up. Typically, stocks will move up, have another perhaps consolidation day. Very important that the very next day closes over significant supports, which it did, and then had another gap up to the green side. So far the stock is moving perfectly. It looks like it's creating a nice pennant pattern, or it already created a pennant pattern, and it broke out of it. You can see that here be done. See, the stock had a pennant pattern, finally had that breakout, pushed over that $3 resistance. So now that $3 resistance becomes our support. And where did it get rejected? So let's see where the stock got rejected. The stock got rejected at $3.25. Therefore, you should put a resistance at $3.25, and the next resistance will be $3.35 after that. So you have supports at $3. So as soon as the stock broke the $3 resistance, the resistance became its support, and you want to put a resistance at the point at which it got rejected, which is the highest point that the stock made it here, and that's $3.25. So your consolidation period is between those 2 price points, and you can watch the stock for another breakout over that price point for the next price target of $3.36. But either way, guys, I hope this was helpful. I tried to make it as thorough as possible and tried to explain as much as I could in the little 40-minute segment that we had together. If you like what you see, please go ahead and subscribe to the channel. If you're not already part of our community, I'm going to leave our website in the link, as well as our Instagram.